Hi, this is Dave Mantell with Stabler Wealth Management. Thank you for joining us for our September economic and market update. So far this year, there's been plenty of headlines, though despite that, the market's really plowed forward. In this presentation, we'll provide an update on our current environment and what we're seeing, as well as what we're focused on and watching as a firm going forward. Before we jump into the presentation, it's always important to take a step back as we do believe knowledge is power. Current volatile periods and periods of uncertainty are always uncomfortable, but by shining a light on what's happening in the economy and the markets, as well as past history we can compare it to, helps our clients understand the current environment out there and how their well-devised plan is set up to get them through these stretches. So jumping in, despite all the headlines and economic concerns, we are currently in the midst of a new bull market going on close to 1 year. Since the stock market bottomed back in October of 2022, we've experienced a really nice solid gain across the board, where both US and main international markets have rallied strongly from their lows. As you can see on this chart, the stock market's up over 25% as of the start of September from where it was at the bottom in the prior year. While this has been a positive run so far, some analysts are saying that we're not yet out of the woods and we should be prepared for a possible downturn. While that's absolutely possible and there's a lot for the market to currently digest, we do want to provide some perspective that historically these bull markets do tend to run for a while. And if history does repeat itself, we may have some good run of positive returns ahead. Based on history, typically this 25% gain for the stock market in the S&P 500 since the bull market beginning is one of the smallest gains in the first year following a bull market that we've seen in many decades. Typically, on average, the first year of the S&P 500 bull market performance has been up 42%. And there's only two instances, 1987 and 1990, where it's been up less than 30. Also, as of the July highs, like I noted, the stock market was up a bit over 25% at about 28% year to date. And while on average, we've seen that the typical bull market performance totals 167% since that bottom. What this means is every time's different and we don't know what's ahead, though there is, per history, some possibility that we'll see the stock market run for a while. And also, I think it's important to note that even during these bull market periods, corrections and market temporary drops are normal and standard. Most years you see a 10% drop in the market at some point. And August, for example, was down about 5%. And while that felt like an uncomfortable month, when you look at history, these are in the norm, and even in a positive bull market can be very typical. As we look at the stock market gains so far, through the end of August, the S&P 500 was up 17% from the first of the year. On the other hand, the Dow was up still positive, but only 5%. And so far, this bull market has been quite uneven. Many of the sectors that did worse in 2022, technology predominantly, have led the charge going into 2023. And likewise, a lot of the sectors that did well in 2022, such as energy, essentially being the only sector that was up in 2022, has actually had a struggle so far in 2023. We'll see going forward, but when you look underneath what's happened within the components of the market, it's really been led by a handful of stock market technology-oriented companies that have really contributed to the outsized gains so far. This is why the S&P 500, which has more tech exposure than the Dow, has really outperformed relatively. One positive this summer is we have seen some more market breadth with broad stocks starting to perform a bit stronger. So we'll see what happens in the coming months to round out 2023. Also, when we look back at the year to date, it seems like distant memory, but the first half of the year was dominated with headlines about the debt ceiling coming up and the possible catastrophe if the debt ceiling was not raised and essentially extended. On June 1st, the Senate did pass a major debt ceiling measure, suspending the nation's debt ceiling and putting caps on federal spending until January of 2025. This allows us to kick the can down the road a bit as we move forward till we see this discussion again. However, it is a reminder that even in good market years like this, there's going to be a lot of headlines, many of which are negative. And so this does not mean that the market is going to go down as we see negative headlines. And it's important to really differentiate a lot of the media headlines and noise out there from what the stock market performance may be. As we look at some of the positive catalysts for why the stock market's been on such a roar this year, the number one to point to is inflation. It wasn't long ago in May of 2022 where inflation was at nearly 9% growth year over year, the biggest numbers we'd seen since the 1970s. As we moved into 2023, we've continued to see inflation decline at a much faster clip than anticipated. May of this year, inflation was only up 4% from the prior year. I say only, it's still an elevated measure, but less than half of the growth we were seeing a year earlier. As we moved into June, the inflation number was down to 3% increase year over year. From our view, nobody expected inflation to come down as quickly as it has if you went back to where things were at September of October of last year. And so throughout the year, we have seen inflation easing. It's important to remember that 3% is still an elevated inflation number, nearly 50% higher than the Fed's 2% target. So we'll see where things go forward, and we do think sticky inflation is still a concern out there to keep on the radar. But nonetheless, it's been positive seeing inflation come back down from the lofty levels of 2022, and that has been a big-time catalyst in terms of the stock market comeback we've seen over the last 11 months or so. As noted on this chart, that June inflation number, by the way, is the lowest since March of 2021. So again, a year and a half since we've seen inflation back down to this level. Another catalyst in our view for the strong stock market behavior and prospects going forward for that matter is that we do see a record amount of cash on the sideline. As you can see on this chart, as of the end of June, cash was well over $5 trillion in the US, obliterating past highs that we've seen over the prior decades. What this means is there's being a record amount of cash on the sidelines. In our view, that is a positive catalyst where ultimately much of this cash stock will go back into the economy or the stock market, providing a possible tailwind down the road. Furthermore, this nice cash cushion allows folks to better, hang on and hold off from, dire straits during a possible recession, providing just some essential cushion as we move into some of those potential concerns ahead. Therefore, as you look at history, going back to 2009 market bottoms and 2020 during COVID, generally highs in cash accumulation tend to coincide with market bottoms. And as we saw in 2009 and 2020, those highs in cash marked near a bottom, a month or two ahead of that, which turned out to be a strong stock market following. Again, there's a lot going on out there, but just with the same thing as declining inflation, record amount of cash in our mind does set up well as a positive catalyst for the market going forward. So when we look at the current environment, interest rates is a key component as we go forward. In response to the slowing inflation, the Fed, after 10 record consecutive interest rate hikes, saw a much anticipated interest rate pause in June of this year. The markets let out an exhale across the board, thinking we may be close to the end of these high interest rates. In July, however, the Fed went back to hiking again, and in August, they did another pause. Currently, the Fed funds rate sits at 5.25 to 5.5% range, some of the highest numbers we've seen in well over a decade. This brings the question of what are we going to see for rate hikes going forward. There is some view that we might see another rate hike in September or October of this year. I think the one thing that investors need to be prepared for is even if we do see rate hikes, stop, that doesn't mean we're going to see rate cuts anytime soon, especially as the economy continues to be resilient and hold on pretty well. And so we view that investors across the board need to be prepared for elevated interest rate hikes for a potentially longer period of time, and that's just an unknown that we need to brace for, given that's a current reality today. With interest rates going up and inflation still above long-term averages and targets, it is critical to make sure that you're earning good yield on your savings, good interest and income. This is not the case across most banks. As you can see on this chart, the average CD and savings rate was a paltry 1.7% on 12-month CDs and about a third of percent a year interest on banks' money market and savings accounts. This is not going to cut it when inflation is 3% plus. And in our view, the one low-hanging fruit in this environment is earning that interest that you should be. Fortunately, vehicles such as Treasury bills and money market offer very conservative ways to earn that 5% plus interest that better aligns with where the Fed fund rate is. And so you always want an operational amount of cash in your bank account if something comes up very quickly or an unexpected expense. But we do feel strongly that having any excess savings, you need to be earning that extra interest on. How much that is, it's really situational. For a lot of folks, they may say, well, I want, 20 or 30, or in some cases, $50,000 at the bank. That just feels good. That's my security blanket. But anything beyond that, especially if you go 10,000 or more above that number, we really think it adds up to get that extra savings in a, higher interest bearing money market or treasury bill account. And so it's something we really suggest discussing with us to make sure you're earning that interest that you need to be while still having the liquidity and flexibility at your fingertips. So we've seen a unique situation this past year where we have what's called an inverted yield curve. And what that means is interest rate on short-term bonds have been higher than interest rate on longer-term bonds and longer-term loans. This is the case of the inversion. Typically, investors get rewarded for holding longer-term bonds and earn a higher interest on that. So this inverted yield curve is not typical, and historically, many have viewed this as a sign of a recession coming. It is possible that with this inverted yield curve and a lot of other metrics out there, that we will see a recession at some point, potentially soon. Though, if you play that game long enough, of course we'll have a recession, because typically every 6 or so years you have a recession anyways in the economy. And it's been, well over a year since this yield curve inversion has first started. But the main factor, we think it's really important to be thoughtful of how you're investing your bonds and fixed income investments and balancing that higher yield return versus the interest rate risk of holding longer term bonds. And so especially in an inverted yield curve like this, we do see still today, you do get a bit more bang for your buck with shorter term bonds versus longer term maturity bonds. Something important to note is that we are seeing longer term yields and interest rates continue to tick up. Back in mid to late August, at one point, the 20-year bond was paying 4.6% interest, and that's a 20-year treasury bond, so government bond. This is the highest level we've seen in nearly 2 decades, and pretty essentially long-term average returns that you typically see at the bond market. And so again, one big silver lining of interest rates going up is that we're back to a more normal environment where bonds are doing what bonds are supposed to be doing and providing good yield and returns. And so again, to recap, we're still seeing higher interest rate yields with the front end of the curve, so shorter term bonds versus longer term. but longer term bonds are starting to catch up and providing more long term average type returns, which can be pretty attractive to lock into. And so this is something we're watching very closely in the months ahead based on where interest rates go and what the yield curve does. So to follow up on that prior slide, that brings up the question, are bonds back? And largely, we think the answer is yes. Prematurely, we saw a lot of shouts about this earlier in the year, where long-term bonds were back into the high threes or mid 3% range. Again, with short-term bonds providing over 5% return in many cases, we thought that was a little premature. But now, as we've seen long-term bonds continue to tick up to over north of 4%, bond yields are really back to their historical averages. The other aspect of that is that stock markets have been on a bit of a ride here in the past, 11 months or so. And while we believe the stock market to be the number one wealth builder over time, it is getting relatively expensive compared to what bond yields are. And so as you look at this chart here, you could see that bond yields, the income that you're earning on bonds, are right in line and equal to equity yields. So basically what company profit and earnings are as a percent of the stocks. And so for much less risk when dealing with bonds, you're earning a similar return yield on that. Also, as you can see in this chart, we could go decades where earnings yields go down. So basically stock market prices go up faster than earnings and profits. And so this can continue on for many decade trends. But I think what it does is just a good reminder that bonds are paying what they normally do. And so this past 15 years where you couldn't earn anything on your bond funds, that whole stock market Tina, there is no alternative, is not the case by any means now. And we believe balance is key. Having the right amount of bonds, having the right amount of stocks, the right income plan for your picture is really what's going to drive investment success for our clients. As we look forward at what the stock market has ahead, as we've gone through so far in this presentation, we could point to many positives and many concerns out there. On the positive end, inflation's come down quicker than expected. There's a record amount of cash out there on the sidelines. Company earnings and profits have been more resilient, and the economy has been more resilient than many had expected as well. We've yet to have technically a recession to date. And so those are all positives for the stock market. Regarding the hurdles out there, inflation's still higher than its long-term averages and the Fed's target. And on top of that, with interest rates up, we're going to likely see some impact on the economy at some point. For example, 2025 is going to be a big year where a lot of companies have to roll their loans. And so many are still sitting on 3, 4, 5% loans at low interest. But as those roll into 8, 9, 10% loans, that's going to put a lot of pressure on a lot of companies. Same concept as mortgages, right? Many people are able to afford their house payments at a 3% mortgage. At a 7 or 8% mortgage, that could be a different story. And so there's a lot of positives, but also concerns out there. From our view, the number one factor going forward for the stock market is going to be company profits and company earnings. Remember, when you buy stocks, you own companies. You own a share of those companies in that index. Or if you buy Microsoft or Boeing stock, you own Microsoft and Boeing. You own a piece of that company. And really the driver of profitability and stock market growth over time is seeing that company grow earnings, grow profits, add productivity, add new efficiencies, add technology. And so that's going to be the number one thing to watch. As noted previously, from historical metrics like a price to earnings ratio, the stock market is expensive. It's similar to the 2021 highs that we saw before the big stock market drop. On the flip side, company profits, while down the last few months from the prior year, have hung in there better than expected and been pretty resilient. For example, in the second quarter, company profits were supposed to be down 7% from the prior year. They were still down, but down 2 to 3%, so much better than down 7. And if you take out the energy sector, company profits were actually up from the prior year. It's anticipated that we're going to see company profits and earnings start to turn a corner and pick up, though it's really difficult to forecast such. And so, again, in our view, one of the number one things to watch from a stock market perspective is how companies' profits, earnings perform going forward, especially given the current lofty stock market valuations that we're seeing today. The number one question we're getting from clients is, when is that recession going to occur? We're expecting a pending recession. When is that going to be? And the answer is nobody knows. For the past year, every single publication you open, every news headline, all the talking heads and forecasters out there have projected that we would have a recession by now, but it hasn't happened. Unemployment rates are still very low. Again, company profits have hung in there okay, they're down a bit, but overall it's been a decently healthy economy despite everything going on. And so it's impossible to know when we're going to have a recession. We'll have one sometime. Again, recessions are normal. They typically happen every 6 to 7 years. But whether that's at the end of this year, next year, or in 3 years, nobody can tell for sure. The most important thing is as we go through periods of uncertainty like this, there's current steps that we can do to really protect ourselves. First off is remaining financially liquid. Having an income plan in terms of where your retirement income comes from, knowing if you have an emergency where you're going to grab those funds from and making sure they're in a secure place, that is the number one factor in terms of getting through difficult periods. In addition to that, it's a good time to model out any large cash obligations that you have. Also, it's a good time to do a spending plan and just make sure you're really intentional about your budgeting and prepared for any big expenses coming down the pike. And lastly, we are going to continue to see a lot of headlines about recessions and economic concerns and worries because that's what grabs eyeballs and that's what the media clings on to. And so try to avoid those headlines. Again, as of last September, October, every headline you saw in the media was negative. Recession coming, layoffs are happening, the economy's in dire straits. Since that point, as we've gone over, the stock market's rallied 25%, right? And that coincided with record levels of cash and people getting out and missing the boat on that. And so the number one thing is having a strong game plan, sticking to that game plan, and avoiding different, reading and activities and headlines that can be anxiety producing and make it hard to stick to your game plan. And so in summary, we believe that investing in the stock market is a long-term commitment, and it's crucial to stay the course even through difficult periods. And, again, recessions, volatility is part of the market experience. This is partially why the market does so well over longer periods. And it's what you can do is control and make sure you have a plan to get through stretches like this. And so we're going to continue to see multiple factors key in deciding the direction of the market in the short term. That's where interest rates go, strength of economy, unemployment rate, company profits. But over longer term periods, we do expect the stock market to get it done. And so as your financial professional, we are committed to keeping you apprised of any changes and activity out there that we should be focused on. And once again, seasoned investors know that stock market is a long-term investment. And that long-term investing is not linear. It doesn't happen a straight line, and it requires patience and discipline. So staying the course, maintaining the consistency of a well-devised plan, being long-term focused, has historically served investors quite well. So as we look at the key takeaways that we've covered today, it is possible that we're going to see another interest rate hike this year. Even more possible is that we're going to see interest rates be higher for longer. So that's something to be prepared for. And there's a silver lining, especially for retirees and those getting close to retirement, is earning high interest on your safe investments is a big deal. While the stock market is officially in a bull market, don't be surprised if we have more volatility. Again, that doesn't necessarily mean we're going to go through a big drop, but corrections are normal. 10% corrections happen nearly every year. and we haven't had one yet this year. The cost of borrowing is still elevated. Interest rates are still on the rise. So pay down any debt that has higher interest rate. Focus on that, 7 or 8% HELOC, not the 3% mortgage. And it's always wise to make sure you're reviewing your budgeting and spending plan and being intentional with that, especially as we go through uncertain periods like this. And review income producing investments. Remember, a well balanced portfolio is critical to get through volatile stretches like this. And, bonds are paying what they typically do over long term averages. So we do believe bonds are back as a key element of investment portfolios. And this is just a great time to practice patience, remain focused on your personal long term goals, and control what we can control. While inflation is slowing down, it's still well over that 2% target that the Fed will like to see. And so we're likely going to continue to have volatility till we get back to where the target is. And remember, should a recession happen, recessions happen, typically every 6 to 7 years. And we do want you to be prepared. Having a solid investment strategy as we do is key towards that. And we are here to help our clients create well-crafted plans, customized for their own unique situations, and personalized to them and what their own needs are. We consider variables such as time horizon, tax implications, liquidity needs, risk tolerance, personal objectives. So it's important that your investment portfolio is tailored to what you need out of it. And so, again, proceed with caution. Looking at past bull markets, it's very possible we continue to have a good run this year, but we would be surprised if we don't see volatility, right? Even if that's temporarily. And as always, we are here for you to get through these tough periods. Lean on us. If you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office or bring them up at your next scheduled meeting with us. We are here for you. We're grateful for all of you as our clients and appreciate the opportunity to partner with you. As a reminder, our Client Ambassador Club is up and running. The way that we grow as a firm is getting introduced to friends, families, colleagues, other folks that we may be able to help. So please keep us in mind. These are tough, critical times that we're going through, and it's so important to have good financial advice. So if you know anyone that you care about that you think might benefit from meeting with us or just getting a second opinion, please put us in touch. You could always pass on, that friend, colleague, family member's contact information. What also works really well is an introduction email. You can include us on there, include your advisor on there with your friend just to connect us to them. And so that's a good way so we can then get introduced that way. But again, we're happy to chat with anybody and do strongly feel that it's so important to have good financial advice during times like this. And thank you for tuning in. Our primary goal is to keep you informed, set you up, and keep you knowledgeable on everything going out there, and especially the things that we can control. So we appreciate you watching our update, and do not hesitate to call us if you have any questions. Thank you so much for tuning in.